Now let's talk about the second method that takes into consideration the time value of money, which is the internal rate of return method. So the internal rate of return method uses present value concept to compute the rate of return from a capital investment proposal based on its expected net cash flows. Sometimes we call it the time adjusted rate of return method. It starts with the proposal's net cash flow and works backward to estimate the proposal's expected rate of return. So compared to the net realizable value method, where we calculate whether there's a positive return or negative return, in the internal rate of return method, we are trying to find what is the return that comes out of this proposal or this project or this asset or this investment in a percentage way. And then we compare it to what's the minimum desired rate of return. If it's higher than this minimum desired rate of return, then it's accepted. If it's below, then it's rejected. So assume that management is evaluating the following proposal to purchase new equipment. So the cost of the new equipment is $33,530. The yearly expected cash flows to be received is $10,000, and the expected life is 5 years. The minimum desired rate of return is 12%. So if we try to apply the present value and try to see the net cash flows. So the net present value of the net cash flows using the present value of an annuity table is going to be 2520. So let's see how we calculated that. So that's the net present value analysis, where we see the annual net cash flow of 10,000 multiplied by the annuity factor for 5 years at 12%. That's 3.605. So the present value of annual net cash flows of $10,000 for 5 years is going to be $36,050. Compare that to the amount invested, which is $33,530. Then it's a net present value of $2,520, which is a positive value, which indicates that the internal rate of return for this project is higher than 12%. It has to be higher than 12%. So you can see here that this is the present value of annuity at the internal rate of return. We have here the $10,000 over 5 years. We got the present value of these values, and this is assuming that the 15% is the factor that we used, so it's going to be net present value of 0. So basically that's what we do in the internal rate of return. We try to find the rate of return that's going to make the net present value 0. In other words, how much we get as a present value for those annuities compared to the initial investment. And if it's 0, then this is the rate that we consider to be the internal rate of return. So when equal annual net cash flows are expected from a proposal, as in the preceding example, the internal rate of return can be determined as follows. So here we have a few steps that we're going to follow. First step, we have to determine a present value factor for an annuity of $1. How we calculate that? We basically get the amount to be invested, and we divide it by the equal annual net cash flows. So that would give us the present value factor for an annuity of $1. So we got the factor. We go to the table. We locate the present value factor determined in step 1 in the present value of an annuity of $1 table, and we locate the number of years of expected useful life. So in our case here it's 5 years, and then we proceed horizontally across the table until we find the present value factor that's similar to the computed value, and we try to allocate or identify the internal rate of return by the heading of the column in which the present value factor in step 2 is located. So I think a better way to understand these 3 steps is by going over an example. So assume that management has a proposal to purchase new equipment. The cost of the new equipment is $97,360. The yearly expected cash flows to be received is $20,000. The expected useful life is 7 years. So the first step is to calculate the present value factor for an annuity. We get the amount to be invested, which is the $97,360. We divide it by the equal annual net cash flows, which is $20,000, And now we got the factor, which is 4.868. The second step, using the partial present value of annuity of $1 table shown in Exhibit 9, in a period of 7 years, the factor is going to be this 4.868. That's the value we're looking for. Would be related to what percentage? And in our case here, it turned out to be 10%. So the internal rate of return for this proposal is 10%. But let's try to explain this a little bit more. So we got the 4.868. We go to the annuity table, the present value of annuity of $1 compounded. We go to 7 years, okay? And then we start looking for a factor that's close to the 4.868 that we calculated. And here we found it. So we go up and see what percentage is that. And once we see the 10%, this means that this is the internal rate of return. So the 10% based on this factor is the internal rate of return. So if I go back here, so using the partial present value of annuity table that we had here, in a period of 7 years, the factor 4.868 is related to the 10%, as I just showed you here. The 4.868 turned out to be related to the 10%. So if the minimum acceptable rate of return is 10%, then the proposal is considered acceptable. So what if the minimum acceptable rate of return is 12%? Then we cannot accept this project because, or this proposal, because the internal rate of return is below what we accept. But the good thing about this method is that it can tell you like how or what is the profitability of that project based on a percentage. And I think that's a useful tool for decision making. So several proposals can be ranked by their internal rate of returns, and the proposal with the highest rate is the most desirable. That's usually one of the benefits of the internal rate of return method. So what are the advantages? One of the advantages is that it considers the cash flows of the investment. It also considers the time value of money, because you can see here we are using present value tables. It also ranks proposals based upon the cash flows over their complete useful life, even if the project lives are not the same. Like everything, it has few advantages. So it has complex computation, which I think it's a little bit complex if you're not very comfortable using the tables. And sometimes you won't find the factors in the table, so requiring a computer if the periodic cash flows are not equal. So in this case, computers would be needed. You cannot just do the math in your like by hand. It also assumes that cash received from a proposal can be reinvested at an internal rate of return, which is not always the case, may not be always valid. So what are the factors that complicate the capital investment analysis? So let's try to learn a little bit about some of the issues that we can face when we are trying to analyze capital investment. So additional factors may impact capital investment decisions. So things that we cannot really include in the formula, things like income tax, uncertainty, proposals with unequal lives, changes in price levels, leasing versus purchasing, qualitative factors. So we'll try to go over some of these in future discussion of the chapter. So the impact of income taxes is one of those obvious things on capital investment decisions and can be material. For example, the depreciation for income tax purposes has much shorter useful life than actual useful lives, and tax depreciation different from book depreciation on the financial statement. So usually tax depreciation is based on something called makers, which is not related to how we calculate depreciation in the financial statements. Another issue that we also mentioned is the unequal proposal lives. So here we have an example for a comparison between an investment in trucks or a truck versus a computer network. And you can see here the truck has a useful life of 8 years, or it's expected cash flows to be over 8 years. But for the computer network, it's only over 5 years, and then afterwards there's no return. Even though the total return is the same, the cost of the investment is the same, but the useful life is different, 8 years versus 5 years. And that can create an issue. So the expected cash flows and net present value for each proposal are shown in the next slide I'll show you shortly. Because of the unequal useful lives, however, the net present value in Exhibit 10 are not comparable. And let's see that. So here we have the net present value for the truck based on 8 years, and it's 12,060. For the computer network is actually higher, 16,805. But the problem is we cannot compare them because it's like comparing oranges to apples or apples to oranges. So they have unequal lives. One is only 5 years and the other is 8 years. Because of that, we have to convert the truck life into only 5 years. So you can see here that we kept the first 4 years the same, 30, 30, 25, 20, and actually 15, and that's the 5th year. And then we had at the very end the residual value of the last 3 cash flows here for years 6, 7, and 8. We put them as a residual value for 40,000. So when we do that, you can see that the net present value has increased to 18,640. So if we compare it to the computer network, I think in this case the truck net present value is greater than the computer network net present value by about $1,835. So to make the proposal comparable, the useful lives are adjusted to end at the same time. This is done by assuming that the truck will be sold at the end of 5 years. That's the only way you can compare two projects or two investments with different useful lives. So the selling price or the residual value of the truck at the end of the 5 years is estimated and included in the cash flows, which in our case here is the $40,000. So both proposals would then cover 5 years, therefore the net present value analyses will be comparable. So let me stop here. In the next video we're going to be going over leases versus capital investments, which I think it's also another issue related to the idea of capital investment analysis.